Okay, so recording has started. Welcome back, everyone, to our week 2 lecture. I hope everyone had a good week, and I've sent out an announcement about the group assignment. So make sure you have a look at your Canvas announcements page, but also look at your email, or you can go to Ed. I usually double post both on EdSTEM as well as on the Canvas announcements page, just in case you may not be on top of all the systems. But Ed discussion, you should definitely make use of, because that's where, that's our key channel through which we are going to all communicate. And if you go to the group assignment page on EdSTEM, you will see that the announcement is there for the registration for your groups. You can also use it to contact other group members, people that you may or may not know already. I will try to ask all the tutors to set aside some time this week and next week in the tutorial so that you can get to say hi to each other. Or even during the tutorial, you can type in the chat box and share your email maybe, and contact each other to form groups. So that's one good way. Also, you can go to EdSTEM and pop your email in there, and I think that's another good way to reach out to people to form groups. Or if you know friends already who are also doing this unit, reach out to them and see if they want to form groups of 3 to 5 people. So far, that's only announcement. In future weeks, I will be making more announcements about the mid-semester test and also the assignment instructions, which will come out next week. And yeah, that's pretty much it. So if you can form your groups as soon as you can, that will be great. So get things ready for your group and build up the team rapport between each of you, so you get to know each other. It's good to always have a quick WeChat meeting or WhatsApp, Zoom meeting, whatever you want to use, Microsoft Teams, which we provide to everyone here as part of a student of the University of Sydney. You're free to use that collaboration tool. So any collaboration tool that you would like to utilize and are comfortable with, feel free to use that for your assignment collaboration. So if no other questions, we're going to begin with week 2. So this week, we are going to look at international financial flows and the balance of payments. So we're going to look at the financial system as a global system, looking at how the economies are connected to each other, and also looking at the accounting system that takes place between all the different countries, focusing on the balance of payments, which is a part and parcel of what we call the current account, financial account, and also the capital account. So all of these 3 accounts make up the balance of payment system that is part of the global accounting system to measure how much money is moving between the different economies around the world. And in the next few weeks, we'll then begin to touch on exchange rates. But I think it's very important for us to have a good foundation of the international financial system before we move into the quantitative details of exchange rate system and how it works. Because this week, what we talk about this week, it's going to give us an understanding of why we need exchange rates at all. Why do we need this kind of financial asset, right? Because ultimately, exchange rate is about the currency conversion between the money, right, of 2 different countries. So therefore, we are looking at the conversion of the value of 2 different financial assets, because currency is a type of financial asset. And so we need to understand the system first before we understand, before we look at the details of the calculations of the valuation of exchange rates. So let us begin by moving on to our summary of the agenda for today. So we are going to look at 3 items. We're going to first focus on national income accounts. So this is the way in which each country is able to measure the inflows and outflows of money. And it uses a debit credit system to measure how much money flows into and out of a country, how much goods and services does it produce. So it's a quantitative measure of how much production a country has been able to carry out over a period of time. So GDP, gross domestic product, right, is one of these measures of national income accounts. You can also have gross national product. We'll also look at that, GNP. So these terms are jargons, acronyms that we will become very familiar with after today's lecture. Then we will link national income accounting, GDP or GNP, right? Link these concepts for an open economy, the globalized economy of different countries around the world. How does GDP work for all of these different financial systems around the world for these different countries? And then we zoom into the BOP, the balance of payments accounts, which can be separated into the three types: the current account, the financial account, and also the capital account. And I'll define them and link them all together for you. Okay, so let's start off with this national account. Let me clear the scribbles and look at national income accounts. So when we talk about national income accounts, we are talking about three different ways actually to measure money in terms of the economic production during a given time period. Okay, so it's not a static number for a single snapshot in time. It's a measure, what we call a flow measure. A flow measure looks at the output of a certain economy over a period of time. So in this case, we are looking at the income earned by a certain nation's production, the productivity it has over a period of time. So usually this is measured over a calendar year, okay, over one whole year or a quarter. So in the US, they would publish quarterly figures of their unemployment rate, their inflation rate, but also their GDP, so quarterly figures. Then you can accumulate them 4 times over the year to get you the annual GDP figure, right? Gross domestic product, which I've noted down here, which I'll define a bit later, okay? So you got GDP and GNP that I'll come to. But national income, by definition, is the income due to the production of any nation. So it could be China, US, India, Australia, Finland, Sweden, any country that produces some goods or services would sell it domestically and to a foreign nation. When that happens, it would generate income. It brings in money, right? Flowing into that country. So this is what we mean by income, and what they produce, what each nation produces, is what we call factors of production. These economic means of production, right, can be first measured by adding up the total money value of the production of all goods and services. So if we try to estimate the total factors of production, we are looking at the total economic activities that produces all the goods and services accumulated in an economy, okay, produced by any economy over a period of time. So again, this is what we call the flow measure over a period of time. It's not a stock measure. Stock measure is a measure that is taken at a certain single date or a single static date, not rather than over a period, over a calendar year or a quarterly figure. Okay, so we are looking at a flow measure here when we talk about income and factors of production. So how do we measure national income then? Let's break it down. So to measure national income, we are going to use 3 different means to do so, and they are all equivalent, hence the equal signs that you see here, right? You could either measure it by the spending, the total spending, expenditure from domestic and foreign buyers. of goods and services. So that's one dimension that you can measure the total amount of income generated, how much people spend on goods and services in an economy by local people, by domestic citizens and foreign citizens. You could also look at it from the income perspective. People who sell goods and services in an economy, how much do they generate in income? It should be equal, right, to how much people spend. Also, the value of production is the third way in which this can be measured. So let me describe each of these in detail. So if we want to look at P, right, for example, the value of production, this is what we're trying to measure. We're trying to measure the value added at each stage of production in the supply chain. Now, when we talk about the value of production and supply chain, we are looking at how raw materials are translated into a certain good. Okay, as from a primary producer, pass it to a secondary producer, and out comes a packaged good. Okay, so raw materials could be plastic, okay, or rubber. Putting this together, you produce a shoe through the design and value added. Out comes a pair of sneakers, right? NBA sneakers that is worth 50 times the cost of production. Okay, if it's sold by Reebok, owned by Shaq, right? Shaq O'Neal, for example. So that is what we call value of production. It's value added at every stage. And we add up all of these values at the supply chain and look at the total value of production. How much is this good or service worth at the end after it reaches the final stage of production? So this is one way to measure the production measure of GDP. And under all the different industry accounts, right? All the industries in a certain nation. So you could be looking at a retail industry. You can be looking at food and beverages, hospitality industry, travel industry. All of these would have their own value of production. If you look at the total amounts of value of production across all of these industries and add them up, that's your GDP. Okay. Secondly, you could be adding up all the income received from the production of goods and services in any nation. Now, how do we know what the income is received for the sellers, right? Well, this can be measured via wages and salaries, the taxes on goods and services, minus any subsidies provided by governments, okay? And of course, profits as well. So all of these contribute to the income for sellers of goods and services. This should be equivalent to the value, total value used in the supply chain value of production approach. So those are the two means, okay? So because sellers are businesses, right? These businesses hire employees. These employees would charge wages and salaries. So we're looking at the income and the profits as well by these businesses. All of these added together should equal the production value of goods and services in any economy. The third aspect is what we call expenditure. It's how much people consume. It's based on the total value of consumption or spending on capital goods. Capital goods could be factories, okay? People could be buying factories to produce goods and services. It could also be spending on consumption, buying that pair of sneakers, right, that I talked about, produced by Reebok, owned by Shaq, right? So all of this spending on goods or services should total up to the income that goes into the pockets of businesses and their employees, which should also be equal to the value of the production, okay, by these companies across all the industries in an economy. So don't forget, if we look at this from an open economy approach, right, so global financial system, all of these could contain expenditure or income or value of production of foreign businesses as well, okay, foreign businesses owned by the domestic nation. So the US firm, right, multinational, could open up another firm, a subsidiary in Australia, okay, like Google has their Australian head office in Sydney, okay, in downtown Sydney. So they produce income. That income will flow back to the US, okay? And I think they're paying minimal taxes, which is an outrage at the moment because the local citizens are crying out loud saying that Google does not pay any taxes in Australia. Okay, so that's an issue that we can discuss at another time. But these foreign businesses owned by another domestic country, right, like a multinational firm based, say, in the US, right, that becomes a foreign income that flows back to the domestic country, okay? And this also will contribute to their value of production, income, or expenditure, okay? Whether they're foreign buyers or local buyers, whether they're foreign sellers or local sellers, but all of this would go back to the home country, okay, that owns that firm, that open up this foreign subsidiary. Okay, so as you can see, right, this can become a bit complicated because there is going to be imports and exports as we open up the economy, right, to the global system, because E, I, and P is now not just internal, it's going to be related externally to other countries around the world. So that's why we need to be looking at two different terms to measure forms of total production, okay? So again, if we want to look at national income, right? How much does a country generate in income, which depends on how much they produce, which depends on either P, I, or E approach, right? The key measure that most of us would have heard before is gross domestic product. You may have also heard of gross national product, and the difference between the two is really the geographic boundary that limits GDP versus GNP. GDP, gross domestic product, are the factors of production, the value of production of a nation for all the businesses and individuals or citizens of a domestic nation within that country, okay? All the values produced within the country. Now, GNP is different. GNP includes all the foreign citizens of the domestic nation that resides overseas. It also includes the businesses that resides overseas as well, that is headquartered in the domestic nation. So GDP excludes the Google office in Sydney, the income that it produces. But GNP includes the income produced by the Google office in Sydney. Okay. Are there any questions on the differences between GDP versus GNP? Should I clarify further? Is everyone okay with that? Any questions or thumbs up? All good? Okay. I think the best way, let me show you a picture. That might be a better way. Just, okay. This is a very good one. Okay, this one. Let me just drag it out. Over here. Yeah. This is a great way to differentiate visually the difference between GDP and GNP. As you can see here, right? The left is GNP, the right is GDP. GNP is the value of all the goods and services, as I've said, produced by a country's residents and businesses, okay, regardless of the production location. Okay, so this measures the total production, okay, both domestically in US and also for US firms residing overseas, like the Google office, right, in Sydney. That income is going to be captured within GNP. GDP, on the other hand, measures all forms of production inside a country, no matter who makes it, okay? And so that's why most people use GDP, because they want to look at only the factors of production or within a nation, rather than all the foreign businesses that it produces any income outside the nation itself. Does that clarify the definition between GDP and GNP? Yeah, Daniel, does that clarify the difference? Yeah, so GDP is what a nation produces domestically, okay? All the businesses within that nation. But GNP is all the, for example, US firms that resides both in the US and outside that. Okay, good. Yep, I think that clarifies it. Then moving on, after understanding GDP and GNP, right, I'll relate the two later on again, okay? So Yiran is giving us an example. Let's have a look at this example. So everyone can focus on the chat box if you like. I'll read it out as well. The salary of a Chinese professor in USyd, Sydney University that is, would be measured in GDP, but not GNP of Australia. Salary of a Chinese professor in UC. Yes, that's right. That's right. Correct. Yep. That's right. Yeah. Does GDP include all the output foreign companies as well? Only within the nation. Yes, it does. RT, yes. It's all the production within a nation. That's right. It could be a foreign business as well that helps to produce, right, within a nation like US, for example. So it's all companies, but only within the country US and nowhere else. Yep. But GNP is bounded by citizenship. That's why we need to include any business, US businesses overseas, because these overseas businesses are US businesses. Hence the differentiation. The boundary point is citizenship, not geographic location. Right. So if we want to look at GNP, first of all, this is gross national product. This is the value, again, of all the final goods and services, whether you measure it with the capital P, capital E method, or capital I method, right? Produced by a nation's factors of production in a given period of time. Hence, I have to clarify the flow, right? Rather than stock. The flow is when you measure something between two dates, usually a quarter. Every quarter, you can measure and output a GNP and compare against different countries to see how much each country has performed in production over this quarter. Now, what are these different factors of production? I talked about the value chain, right? The P part, the capital P in the previous slide. This can include any forms of input that goes into producing goods and services. People, right, is one human capital that goes into factors of production. Labor is what I mean by human capital. It could be high-skilled labor or low-skilled labor, right? You could also have, instead of human capital, you could also have capital goods. Now, capital goods include factories, buildings, equipment, right? So if you bring capital goods and human capital together, usually with the right amount of raw materials, like natural resources, like rubber, okay, from rubber trees. Or you could have steel produced from, actually steel is not a raw material. You need the actual copper, you need the actual silver metal, and all of the components, right, to come together, undergoing a transformation process by labor with capital goods like a factory, a building. Within that, you've got equipment to transform these primary products into secondary products like steel or alloy. These steel beams, for example, could go into the construction industry to help to build houses, for example, and sold at the wholesale level, right, to retailers like at Bunnings in the local hardware store that people can buy and use it for their homes in construction, just as an example. So these values of final goods and services that will undergo a lot of processes, right, to add value to it, so that ultimately you are left with the capital P, right, at the end for the total value. This in Australia, if we're trying to measure the GNP, right, in Australia, what we're trying to look at is all the goods and final goods and services produced by Australian-owned factors of production. Remember, when we look at GNP, we're looking at the citizenship boundary, right? So we also include overseas Australian companies owned by Australia. So BHP may have subsidiaries in Fiji, right? In East Timor, where they have a lot of gas facilities there, right? To mine gas so that they can send it back to Australia to process it and then on-sell it to other countries. Things like that, right? Mining companies does this a lot. BP is a UK-owned company. They own also overseas facilities, right, in foreign nations. Of course, they pay a tax, right, to these foreign nations to be able to mine resources and process it. So this is the definition of GNP. And GNP is a measure of national income. So what does GNP include then in detail? We talked about the factors of production, right? But that's not so precise. I only generally describe to you what are these factors of production. But how do we actually calculate it? What are we adding together? Well, remember, we could measure GNP or GDP via capital P, capital I, or capital E, right? One of these three ways. We can then break it up into the final goods and services spent by domestic consumers on these final goods and services. That's the consumption. That's the expenditure, the capital E, right, that I talked about. You could also have investments, expenditure by firms on capital goods. Okay, so that's another avenue of adding value to the expenditure on the final value of goods and services. So all of these stack up. You're adding a lot of all the consumption, all the expenditure by domestic consumers, how much they pay for the final goods and services. But you also need to add in the investments, right? The expenditure by the firms on the human capital, and also on buildings, on the labor, buildings, and equipment to produce the goods so it can be consumed, right? So you add them together. Governments could step in and buy some of these, right? They could invest in public infrastructure to build roads, for example. And so these government purchases is another form of expenditure on the final goods and services produced by firms and individuals, usually firms. So if we add up C, I, and G, right? Consumption, investments, and government purchases, this becomes our GNP. Okay, and you can directly measure these because each organization, like a government or a firm or individuals, they need to record their behavior, right, via cash flows, either by spending on the credit card, that's measured, that's recorded, or a firm that would spend on buying a factory, setting up a factory. Again, that's recorded under the accounting system. So you can't escape from not being recorded, okay? That's what you call a black market, right? But for assuming that all of these measures are recorded under the official accounting figures in the official accounting system, I'm not talking about black market here, but above ground, right, transactions, then C, I, and G can all be directly recorded. How much expenditure has been expended or spent by these three different sources? If you add all of these up, right, and then look at the difference between how much does a nation export minus how much they import, this is called the net expenditure, okay, by foreigners on domestic goods and services. This is the current account balance, which can run into surplus or deficit, okay? So what do we mean by a current account surplus? Well, current account surplus means exports greater than imports, okay? So the net of exports and imports of all of these expenditures, whether they are domestic governments, domestic firms, or domestic consumers versus imports, which are produced by foreigners and sending goods and services into, say, Australia, the difference between these two is the current account balance. Now, the current account, remember at the beginning in the agenda, I mentioned balance of payments, right? Balance of payments consists of three components. The current account is one of them, okay? So exports and imports only measure one of the three aspects of the balance of payments that looks at the financial flows around the world between countries. Okay, so national income is not same as the balance of payment. Let me remind you, it only looks at the total amount of goods and services produced by a nation, whether it's bounded geographically, that's GDP, or whether it's bounded by citizenship, which is GNP. So GNP and GDP measures are both produced by governments because they measure different dimensions, right, of the factors of production by companies. Let me show you this graph and we'll take a pause, take a breather and see if you have any questions, okay? So just as a measure, this is just as an example, this is the US Q1 2016. I'll come back to your question, Xu Ying, after I go through this graph, yeah? Just hold on a sec. I'll come back to you. Yeah, great question there. So if we look at this graph, right, we're measuring on the y-axis the billions of dollars. So this is 19,000 billion, which is trillion, right? Oh, no, sorry, that's not trillion. This is 1,000 billion. It depends if we look at the British system, aren't we? So I don't want to confuse things. But in the British system, this would be trillion. Okay, you got 12 zeros, which is trillion. So we've got $19 trillion or 19,000 billions. Anyway, you got 12 zeros, okay, after the 19. That's how much GNP US produced in the first quarter of 2016. This can be broken up into the 4 components: the consumption, expenditure, okay, of the domestic consumers, the investments by domestic firms, and the government purchases, netting out against the exports and imports. That takes into account foreign imports as well. So C plus I plus G plus the exports minus the imports, which forms our current accounts, okay? If you add all of this together, you will get GNP, okay? So that is how we measure GNP, C plus I plus G plus exports minus imports. And the total GNP is very close to $19 trillion. And you can see in the US government is running a current account deficit in this case, because the exports is less than the imports, contributing to a negative current account figure. Okay. Is current account balance always negative? Ooh, that's a great question. We will talk about different countries, in particular the US as a case study. The US in the past 10 years have been running current account deficits. And I will come back to you to answer more as to why. Some countries always run a current account surplus, okay? But the US has been running current account deficits mainly because they are a debtor nation. They borrow more than what they export to other countries, okay? So Artie, great question. I'll come back to you to talk a bit more. It's a formula of GDP as well, right? No, yeah, not precisely. GNP is different to GDP. So isn't this also GDP? Different. GNP is not the same as GDP, and I will look at the relationship later. Mathematically, I'll show you, okay? In a few slides, I'll come to that, okay? I think I missed one question before, so let's take a breather and go back to Xu Ying's question. If country A lends money to country U, okay, Australia to USA, for example, we lend USA $100 million. Does that also belong to GNP? So if we go back to the definition of GNP, right? We're looking at the value of goods and services produced by a country's residents and businesses, regardless of the production location. So it would, that's right, it would include it, yeah, because we're looking at the foreign companies owned by a domestic nation, yes. Okay, but GDP won't, because GDP only captures what is produced within a nation, okay? So we'll come back to this and look at this in detail, later as well and answer it further. Okay. Because the mathematics, I think, will clarify a lot of these questions that all of you have at the moment. Okay. But great questions, keep them coming. And if I still don't answer your questions by the end of the lecture, yeah, feel free to continue to ask. So GNP is a measure of national income. So we define that. And sometimes, actually all the time, nearly all the time, the government would also produce another number, which is GNP adjusted for what, right? This is GNP adjusted for depreciation. Okay, what do we mean by depreciation? Well, when we looked at GNP, right, we only looked at the factors of production. We didn't really calculate the depreciation, the capital loss that occurred to produce the goods or services, right? Because in accounting, depreciation is the reduction in the value of assets, right, over time. Now, this is not captured in GNP, so you could net it out, okay? But by definition, the word gross, right, does not net out depreciation. Therefore, if you want to take into account depreciation, we need to use another term. This wouldn't be the gross national product. This would be the net national product. When we use the word net, right, we are taking out the cost of production, the depreciation that occurred. So be very careful. Whenever we see GDP or GNP, right, they don't take into account or adjust for depreciation. Secondly, GNP does not take into account the transfers of funds to and from other countries that can change national income. For example, you could have expats, right? Expatriates working in another country, right? And the payments of these expatriate workers would mean they would send some money home. And when they send this money home, this income is not captured in GNP. Nor does it capture foreign aid or pension payments sent to expatriate retirees. But that said, these transfer of money that does not involve forms of production, right? They're simply like gifts or donation, right? Foreign aid is a donation, transfer of funds. GNP does not include these kind of donations or free flow transfer of funds because they do not involve any factors of production. There's no goods or services that is reciprocated, right? So these are one direction transfer of funds that happens once and that's it. Okay, it's done. Okay. So we have a question. Awushi asked, are sold secondhand goods included in calculation of GDP of the current year? No, because these are already sold originally in the total value of the final value of goods and services originally. So we can't double count secondhand goods that are sold. That's right. Oh, okay. Amortization of intangible assets like trademarks, right? Trademarks. Let me fast forward a bit because these questions will definitely be answered by the end of today. Trademarks and also patents, right? They are actually, I'll talk about this more later on, if I may fast forward to show you, they are covered under capital accounts. Okay, we talked about current account already, right? As part of the balance of payments, the current account is absorbed under the GNP, right? But it is not captured under the capital account, okay? So the amortization of intangible assets are not captured, okay? Because it's under the capital account, which is defined as the flow of any assets, right? That is non-market, non-produced, so they are not part of the final value of goods and services produced. They are classified as intangible assets as you define here, like forgiveness of debt, copyrights or trademarks, okay? So capital account is where this will be captured. Qing Yi. So we'll come to that later on under balance of payments, okay? But let's rewind now back to where we were at, right? Now, someone asked me before the difference between GDP and GNP, right? This is the difference, okay? Let me annotate again. The difference between GNP and GDP is the following. GDP is GNP, the gross national product, defined by the citizenship, right, of the firms and the individuals they're at, whether they're individual governments or firms, right? Taking away any payments from foreign countries for factors of production, plus any payments to foreign countries for factors of production. So if you look at the sum of these two, right, these are the factors of production of outflows and inflows due to the movements of funds from and to foreign countries. Okay. GNP, remember, includes foreign businesses owned by the domestic nation. Therefore, we need to net them all out, net out the factors of production of foreign businesses owned by domestic nations, right? Like the US multinational with Google offices in Sydney producing income. You need to net them out if you want to calculate the GDP only. That is why I went to that visual diagram, right? I showed you before to define the difference between GDP and GNP. Okay. Is that clear? Yeah, that GDP is marked by the nation, okay, the production of a certain nation within the boundaries, geographic boundaries of that nation. That's why it does not include foreign payments, inflows and outflows back to the home country. Okay, we need to net it all out because GNP includes it, whereas GDP doesn't. Okay. Any questions? Yeah, because this would clearly define the difference between GNP and GDP. Okay. Zhuo Chen, what about antique? What if I find an antique and sell it in an auction? Is that GDP? Oh, okay. This is a very tricky one, isn't it? Because the antique, it depends if the antique has undergone factors of production, right? If it hasn't, this will be under the sale and purchase of assets that are basically transfer of funds. So if you sell it at an auction, is it part of the value of production? No, it isn't, because you're not transforming raw goods, right, into final products. So it won't be under the GDP. Yeah, it won't be. Does that answer your question, Zhuo Chen? That's a very good question. It's like a second-hand good as well, right? If you sell it at an auction, yeah, it's not included. Yeah. What indicators, GDP or GNP, is more important to consider for an economy? Oh, that's a great question, because economists looks at both. It depends what perspective you're looking at, right? Do you want to look at just what the nation produces? Well, that's what GDP is, right? Or do you want to look at the nation in a global sense, in an open economy, right? Then you need to look at GNP. So there is no better one. Yeah, it really depends on a case-by-case basis, Arushi. Yeah, does that answer your question? Yeah, it really depends what you're trying to measure. Yeah. Are you looking at the global economy, or are you looking at, like, say, Australia just purely by itself as a nation? Yeah, so the Google example is Google is a US company. So it's owned by US citizens because it's US denominated. And so therefore it's a multinational, and it opens up head offices or offices in other nations like Singapore, Australia, China, all of these different countries. And they produce income, right? And so, sorry, yeah, I could be wrong there, in certain countries. So if Google opens up and it has an office in Australia, right, the income that the Australian office produces would be captured under GNP, but not the GDP. Okay, does that answer your question, Angela, with the Google example? So the US GDP would not capture the Google income in Australia, from Australia. Yeah. Would Apple exclusively add to Ireland's GNP because it is legally incorporated there? Oh, yeah. Now we're talking about the legality, right, of these firms. You know, is it legally an Irish firm or is it legally a US firm? From my limited understanding, right, a lot of these tech firms are actually based not by legal incorporation, right, but by whether they are a parent or subsidiary. So although they are legally incorporated in Ireland, right, Apple, that is, they are part of the subsidiary of the parent group, of the bigger group, right, of firm that was incorporated in US. So the income still flows back from Ireland back to the US. Okay, so by that means, right, it won't add to Ireland's GNP, although it's legally incorporated there. Okay, but there's a lot of accounting tricks like transfer pricing that these companies use, right, to avoid tax, but at the same time transfer income back to the home country. Hopefully that answers your question, Paul. That's a great question. You know, what's the difference between legal incorporation versus the ownership, right, of the firm? Yeah, that's a very thorny issue. We need to go into accounting to answer this one, I think, the transfer pricing aspect. Hao Ran Wang asked, Google income happen in Australia. Will it be Australian GNP, but US GDP? Australian GNP? No, no. It'll be US GDP, right? So no, it'll be US GNP, US GNP, but not US GDP. Does that answer your question? Yeah. Okay. But if any of the income stays in Australia, right, then it will form part of the Australian GDP. Okay. But unfortunately, these US firms, right, are very smart. So they use a lot of accounting tricks to send money back home. That's where the Australian government has been complaining a lot about the low amount of taxes, right, paid by these firms. Although they generate a lot of the income, the wealth, right, produced in Australia, but they bring it all back home. That is where the issue is. Yeah. Okay. Let's have a look at the second agenda item, national income accounting in an open economy. Okay, one more question and then we'll move back to the mathematics. I would like to answer questions as we go along, right? That's a good way. Artie asks, what about income of international employees? It depends on the citizenship of these international employees, just like here, right? If we're looking at expats, right, here, this would be defined under unilateral transfer, which would be then not part of GNP. They have to be adjusted on top of GNP. Okay, multinational company employees. It depends on the nationality of these employees. Okay, if they're US expats living in Australia, right, working in Australia, and they send money back home, right, this would be considered as a unilateral transfer. Does that answer your question, Artie? So it won't be under the GNP because they're sending money back home. Yeah. Which is different to if a firm produces something, right, in Australia, a US firm, and then they send that income back home. Okay, then that would be under the GNP because it's classified, it would then be classified under this part, right, here, which is inclusive in the GNP, but excluded from GDP. Okay, because it's a foreign, it's a US firm in Australia, right? So yeah. Okay, I think that clarifies it. So if we use some mathematics to break down, right, the national income identity of an open economy, this is what it looks like. Remember, if we go to what we had before, with a closed economy, we had this, right? But with an open economy, oops, sorry, I accidentally pressed my button on my pen there. Let me just, okay. Okay, so this is a closed economy. All the expenditures spent by domestic consumers, firms' investments, and government purchases. And if we include the current account, which is specified under here, a current account, which is the net of exports minus imports, and add them up, this becomes our open economy national income, okay, which is GNP, okay. Let me come back to you at the break, okay, just before the break. I'd like to explain this first, Arishi, if I may, yeah, okay. So these examples, right, are these under GDP or GNP? Let me come back to you on those, yeah. So remind me if I don't come back later, because if I may see a lot of other questions, right? If I miss your question, yeah, I'll come back to you. So given national income or GNP, right, as one of the measure, breaks up the domestic closed economy with the open economy adjustment, right, which is current account. This is then the definition of the national income of a country, okay? So let me clear that. Any questions around this before I go on and talk a bit more about these different components? Because this is the essence of macroeconomics of a global economy. Okay, this is a standard model used to define the national income of a nation around the world, because GNP includes foreign generated income and expenditure, okay, bringing back to the home country. Okay, so yeah, that's right, exactly. The Y will be the GNP in this case, yep, as we defined before, okay? So this is why in economics is usually, or macroeconomics is usually used for income. If we rearrange the previous equation, right? So what we do here is we are going to make the capital account, the subject, or this part here, right? The subject. We are going to move this to the other side, okay, of the entity. So Y minus this whole component, right, is what we are going to get in the next slide. Okay, that's what we get here. The current account is equals to income minus what is produced domestically. Okay, what is expended domestically. Now, we can compare then the factors of production between these components and think about what happens when production is greater than domestic expenditure. So this is the first case here. If we think of it in terms of the components where one is greater than the other, okay? Export greater than imports, okay? Or production greater than domestic expenditure, okay, like that. If any of these two inequality is true, right, then we get current account greater than zero. Remember, CA is defined as a difference between the net of export minus imports. And this is also same as our trade balance as well. Trade balance is another term for exports minus imports or current account. This, if it's greater than zero, this is called current account surplus, okay? So then we get a surplus, C current account surplus, okay? Let me write it again. That was not that pretty. Down here, if we then look at the other side, okay, if we say have, so this is current account surplus. Down here, if the production is less than domestic, right, expenditure, or export is less than imports, what we get is current account less than zero, trade balance less than zero, current account deficit. And at the end of today's lecture, I will talk more about current account deficit, because that is what the US has been facing in the past decade. And I'll talk about why it is still sustainable and the US economy is still growing in the way that they are, although they're facing current account deficit. There's nothing wrong, right? Australia is a current account deficit nation as well, hugely dependent on inflows of financial investments, which makes up for the current account deficit. But again, to understand that, I think we need to look at balance of payments first, okay, before we come to that point. So current account trade balance is the same thing. Yes, it is. Yep. So current account is same as trade balance, which is the difference between exports and imports, export minus import. Okay. So later on, we are going to break up the current account into two parts, into two accounts, because the current account can also be netted with the other two types of accounts. But I don't want to go there yet until we look at balance of payments, right? Because current accounts balances out with financial account and also the other one, the capital account. Okay, sorry, both are C, isn't it? So I'll use CA here, CA, capital account. But let's not go there yet. I need to define them and tell you what they are before we understand why FA plus CA, right, is going to be equal to the capital CA on the left-hand side here, okay, the current account. So why does capital account plus financial account equal capital account? Okay, I'll show you that relationship later. Capital account is important because if we have a current account deficit, right, like the second case here, this case here, okay, we are going to induce international borrowing because we are going to be exporting less than we import. And in that case, we are going to be bringing funds out of the country more than what we bring into the country. And this is going to be balanced by the flow of international borrowing, because we would need to borrow from overseas countries in order to sustain our economy. Because remember, current account needs to be balanced with financial account, and financial account contains international borrowing transfers. Again, let's leave this point a bit later to understand it fully. Okay, I'm jumping ahead here, but yeah, for the moment with this, I think. Now, let me give you a quick example of an imaginary economy, right? So GNP, the Y that we have could be 100. Okay, so here we got Y, and then that's equals to 75, the consumption, the capital C from the previous slide, plus the total investment expenditure, 25. Okay, here this would be 25 billion, okay, dollars. So defined down here, I mean, you can basically ignore these math in how they calculate 75, right? Because this is a more an imaginary economy. It's a very simple economy that produces only wheat and milk, okay? So basically, this talks about the 75 bushels of wheat plus the gallons of milk, okay? That is going to be consumed by domestic citizens of a country, okay, by an imaginary economy, plus the investment by firms locally. So this is going to be 25, okay, and then we're given that the government purchases is going to be 10. So these are all just given numbers, right, to illustrate the case. So 75 plus 25 is 100, 100 plus another 10, 110. Exports, we export some of the bushels of wheat and milk, so 10 of them, so 120. If you minus the imports, netted against the imports, which is 20, the 20 comes from this mathematical calculation here, 0.5 bushels per gallon, times it by 40 gallons of milk. So that would give you 20. Okay, we import milk here. And so this is going to be net off with what we defined before. Okay, and this is going to give us the gross national income. Okay. Okay, just a simple illustration. I think we can move on and look at the other more interesting aspects of the other ideas to do with a gross national income. So in terms of national income accounting, let's look at the case of the US, right? You can see here, the current account of the US and the net international investment position, right, of the US looks like this. The blue line is the current account, and the net foreign wealth, okay, is the red line. Now, over the past 40 years, since the 1980s, right, 1980s, you can see the US has been running current account deficit as denominated by or represented by the dip here, right, in the blue line, consistently below the zero here, okay? Because of this current account deficit, it has slowly contributed to the need for US citizens and firms to borrow money from overseas rather than paying or lending to overseas entities, foreign firms and foreign citizens. This created a net foreign wealth deficit over time. So the lead-lag relationship is the current account causing the wealth of businesses, US businesses and US citizens and governments to carry on a lot of debts over time. And you can see it going negative over time. So the cause is the blue line and the result is a red line over time. Now, the main thing is whether this red line is sustainable. That is always on the agenda of the US government. Just like Australia, we also face this graph because we are not a current account surplus nation. We are always a debtor nation because what we produce are usually primary products. We don't produce high-tech goods like Japan, right, for example. So overall, our current account always runs into a deficit, which means we need to borrow money from overseas to sustain our factors of production, like capital input and human labor. We import a lot of human labor into Australia as well to help us to produce our goods to export to overseas. So, sure, Artie, to explain again, the current account in the US in the past 40 years, since the 1980s, has been deficits, right? You can see the blue line. This has led to the net transfer of wealth, outflows of money, funds, and inflows of money, right? This is what the net means, to be negative overall for US government, firms, and also citizens. Hence, their wealth, net-wise, has been going down over time. And this is becoming a worrying sign because as the wealth of a nation, which is going to be calculated based upon citizens, governments, and firms, right, together, this could become unsustainable, okay? Over time, this could go down, right, where the repayment is not sustainable. As long as the repayment occurs in a periodic manner to overseas nations, that's fine, okay? So at the moment, it is okay. It is okay, it's sustainable. But over the long run, we just don't know, whether this is going to be the case. Okay. So moving on, I think I spent a lot of time on this graph. So let's move on. And let me just check. Let me go through 3 more slides and it will take a break, right? Because I'm wary of time let's end the whole section and then we come back from the break and look at part 3, right? So I don't break my train of thought as I explain all this, and it doesn't break your questions as well, your train of thought as you come up with questions. So the national income accounts, GNP, right? The Y that we measured so far. In a closed economy, if we go back to what we had previously, that was Y equals C plus I plus G, right? If we rearrange this and move C to the left-hand side, G to the left-hand side, what we have is I, income, equals Y minus C minus G, right? Okay. But if we look at income, which is measured by Y, the total national income, right? That is not spent on consuming by citizens or not spent by governments on purchases. Okay. What are we left with? Then we are left with this income, okay, for businesses, but at the same time, national savings, because whatever that is not spent will be saved by individuals and governments, okay? And that is where this S comes from, okay? And if we go back to what I started with, I equals Y minus C minus G as well, right? Okay. These two must be equivalent then. Therefore, S equals I, okay? So the savings of any nation will come from I. Now, what is I? You may go back, right? That is the total expenditure of investments by businesses, okay? Which means if a nation is able to save money, then they are able to invest back into their businesses ultimately, which would generate economic growth, okay? So this is the key to economic growth. And the multiply effect will kick in, right? As the feedback effect occurs. So let me just clear that. So there are two things here, right? One, this is new. I define S here, right? National saving, which is the residual of the national income not spent on consumption by individuals nor governments, okay? Secondly, we defined this before already, right? That's the investments by firms as an expenditure is Y minus C minus G. If we think about these two, they're the same. So therefore, S equals I. Okay, that's how we get this. Okay, so how do we get Y minus C minus G equals I? Oh, that was from previously. Remember, Y equals C plus I plus G, right? Does that answer your question, Artie? So that was from our previous slide. We defined this for closed economy. That's right. Yes. For GNP. That's right. GNP equals GDP for closed economy. That is right. Yep. Very good. So this means in an open economy, right? Let's extend this. This is a closed economy, right? So for a closed economy, closed, okay? We can open up the borders now. And if we open up the borders, what we get is any investments by local firms plus our exports minus imports. If we export more than we import, we get current account surplus, more money coming into the country. Foreigners, foreign investors, right, are going to be financing our investments, which is under here, right? Foreign and domestic firms and exports minus imports. All of this, if both are positive, this will increase the amount of savings by a nation, which will in turn pump more money into domestic forms of production under C, under G, under I. And all of this would flow back to the national income, you see? So it's like a multiply effect. But anyway, we're talking about a one period system. So I don't want to complicate things. I'll stop at one period and not look at the flow back effect at all, okay? Because that means a lot more assumptions need to be made, right? So I'll stop there. So all you have to understand from this slide is from a closed economy, which is up here, right? I am going to open up the economy so that I now have exports and imports included, and also foreign investments included, okay? So that both of them, if they're surpluses, it will contribute to savings for a nation. More savings, more economic growth into the future, okay? Second aspect of national income accounting that we can play with, right? This is savings and current account. So this is more about savings. How much does a nation save? Okay. More current account surpluses, more investments by foreigners. I am able to save more. I'm able to induce more economic growth. You can also compensate one with the other, and we'll come to that. This is what the US government has been doing. They had current account deficits, right? So what they needed to do to produce savings and investments in the US is to increase I, to bring in foreign investments into the US economy. Now we're going to break up savings into what we call private and government savings. Remember, we had the following relationship before. S equals Y minus G, sorry, minus C minus G, right? If we now include government taxes by adding these two aspects, okay, minus T plus T is 0, isn't it? Okay, so it nullifies each other. So I'm just playing around with government taxes now and introducing it into my original relationship from the previous slide, this one. Okay, I'm putting in taxes into both of these components and see what happens. Okay, this doesn't do anything to the whole relationship because I'm using minus T and plus T, right? So what the government receives in taxes is nullified by what the companies and individuals will pay in taxes. So it's still a closed loop system, right, in this case. But if I now re-examine the relationship via the following breakup of components and put brackets around it, Y minus T minus C. So this came from the original relationship, right? Y minus C minus G, right? They were from original relationship. I'm simply adding these two components and separating them. I can redefine Y minus T minus C as private savings and T minus G as government savings, because let's break this up into two parts. Firstly, our national income minus the taxes that people pay and firms pay to the government, minus any consumption by individuals. This leaves me with private savings, okay, by individuals, right? Hence SP. So SP is Y minus T minus C. I can also break up T minus G here into a definition called SG, S superscript G. This is government savings. This is government savings, okay? Because if the government receive taxes and they spend less, right? So if T is greater than G, right? What the government expends, that means the government must be saving more, okay, than they spend. Hence, this would be positive in that case, okay? So this S here, right, contributes to economic growth as per previous slide. And this is exactly what Keynesian economics is about, because based on a national saving model like this one, if private savings go down, what does the government usually do? Can someone tell me? Chat box, or you can unmute. What does the government usually do by dipping their hands into the economy? How do they help out? If they find that private savings has been decreasing, injection, that's right, RT, thank you. They would increase this either through charging more tax or dipping money into their previous surpluses and using it now, or they borrow money, okay, by issuing, say, bonds, for example, and this would become greater than 0, okay? So there are multiple means through which governments can do this. But anyway, again, the focus of today is not on a general macroeconomic framework, right? As in looking at a dynamic macroeconomic policy. We're not getting there yet. We are only looking at this in a static manner. That's why I just want to break it up into SP and SG. I'm not going to look at what happens across time. Okay, that's what I mean by dynamic. But you can think about it. And I've sort of fed you with a bit of thinking just then, right? The injection that RT rightly added, right? That's exactly what happens in Keynesian economics. The government would play a role in supporting economic growth in times of need. So this is what we can do with the model, we can break up national income into two parts. That is, firstly, into savings and also closed economy savings, and also open it up globally into a global economy in terms of savings. You can also look at it from the point of view of a closed economy where we have private and government savings. So this is still a closed economy, right? As you can see, I don't have plus CA. As soon as I add plus CA, which I can do later on, to open up the economy, okay? And that's exactly what I'll do here from my previous slide. I now look at S equals I plus CA, which I've defined over here in the bottom, okay? This is the open economy. If I now bring it together with private and government savings and put it into this equation here, right? Link it with this one, okay? What I get is basically this relationship here. Because, let me rewrite it so you can see it, right, clearly. S equals I plus CA, okay? But this is also equals to SP plus SG plus CA, right? Okay, you can rearrange it to make private savings a subject of the equation. Okay, so this would become I plus CA minus SG. Okay, and oh, sorry, CA shouldn't be here. This is defined here already. Okay, so if I now open up the economy and define I plus CA, okay, as my SP plus SG, right, my savings, that includes also overseas borrowings as well, right, by the government or by individuals, I can rearrange this equation where SP is equals to I plus CA minus SG, okay, to give me this entity. I can also play around with SG, minus SG, remember? Minus SG, what's SG? T minus G, right, from the previous slide. That's equals to G minus T. And that is how I get this, okay? So playing around with a bit of mathematics with these components allows me to see things in a different way from a different dimension. So it's quite neat in how this whole equation, right, can be rewritten in different ways so that you can see it from different perspectives, which makes it very interesting in macroeconomics. And of course, G minus T, let's expand this further, right? So if CA, if CA is positive, so let's go back. Let me clear this. Okay, that's okay. I will clear it off here. So CA in this case is current account. So if CA is positive, it means current account surplus. Okay, this could be met with more government spending because these two may neutralize each other, right? So if this is positive, we could run a government into deficit by making sure G minus T is positive as well. Okay, so we could have current account surplus and current account deficit. If both of these are positive, this would increase private savings. You see? So say Australia, right? The government runs into a deficit through their fiscal policy, their budget every year. This contributes to savings by private individuals. Also, if we have current account surplus through our trade, export greater than imports, this also feeds more money into our savings as a nation. Okay, of course, they could balance each other out, right? One could be negative, one could be positive, and we have to see the net effect of the two. Okay, right. I think I'll stop here. Let's take a break. It's a good time. We've gone through a lot. Okay, so I'll now feel free to stay back for the question I had. We're going to take a 5-minute break. We'll come back at 4:25. But I think we had a question before. Did I answer that one? I think if someone used pensions to run a business within the country, will it be included in GDP? If someone uses pensions to run a business, pensions, Would this be a factor of production? Pension funds, investments, yes, it would, because the pension ultimately would translate into intermediaries, investments, and this would be used to support a business growth, and this would be invested into capital, right? Capital account, which would be used to buy equipment and set up a firm, for example, to run a business. So yes, it would flow into GDP ultimately, but the pension itself won't. Okay, does that answer your question, Arishi? Yeah. So I'll stop the recording. Yes, the pension is part of the unilateral transfer, right? But after the pension is fed through a company, once it's invested into a company, then that company could use it to buy capital goods. Now, that is going to be a form of factor of production, okay? So the pension investments could turn into a factor of production later on. It's a bit like, what do you do with money, right? That comes into the economy. Well, you could use it to sit on it, or you could invest it, right? Until it's invested, it's not going to be used as a factor of production. Does that answer your question, Artie? Yeah, and that's how wealth is created in a nation, because of investments. Yeah, not because of money sitting around, right? So Arushi, if a country imports technology from a country, is it captured in the current account? So if they import certain technology from a country, it depends on this technology. Like, is it a capital equipment, right? It depends. Or is it a patent? If it's a patent, then this technology patent would not be considered under the capital account. It will be considered under the unilateral transfer. But if it's a piece of equipment, then it will be captured under the capital account. Okay. So I'll just scan. Okay, so we are recording. Balance of payments looks at the country's different accounts for all of its payments to and from foreigners. Okay, so now we're going to use the term domestic versus foreign. Domestic means home country. Foreign means other country that is not domestic. Okay, so US would, if it's domestic, then Australia would be its foreign counterpart. Now, any international transaction that involves two parties, stated here, each transaction is going to go under an accounting system. So everything is properly recorded. So it's not under the table, right? Everything has to be properly recorded so that it can be measured in hindsight to see how much a nation has produced overall, and we can use it for analysis later on by the governments in any country. And also the World Bank would be keeping a tab on all of these figures. So once it's entered into the accounting system, as we know, in any accounting system, you have two sides, right? Okay, you got debits and credits. And on the left-hand side, you've got assets. On the right-hand side, you've got equity plus liability, right? And they're always equal. Assets equals equity plus liability. But under any dual entry accounting system, you need to understand debits and credits. Okay, so every time there is an entry into any transaction by two parties, then we are going to see a debit occurring and a credit occurring. So there's a balance, right, between the two sides every single time a transaction occurs. So feel free to revisit some of your accounting concepts, right? I mean, this is not an accounting course, nor are we going to go deeply into accounting, financial management accounting, and all that, right? No, we're simply going to touch on debits and credits as a tool for us to understand what are the dual entries that occurs when a foreign entity transacts with a domestic entity. Okay. So recall, current account is equals to the difference between exports minus imports, which in an open economy, it's also equals to Y minus C plus I plus G. So that's the domestic component. And this is the current account component, which is the difference between foreign and, domestic minus foreign. Transfer of funds depending on how much exports and imports we have. So we looked at all that, right? So I'm not going to go through that. But now what I'm going to go through is to break down the balance of payments, or what we call BOP for short. So what exactly is a balance of payments? What's BOP, right? BOP, balance of payments, accounts for three things: current account, financial account, and capital account. The current account makes up for the flow of goods and services between a domestic nation and a foreign nation. We defined that already. CA equals exports minus imports. Okay, nice and easy. Financial account is the flow of financial assets, like financial capital. So this could be bonds being sold overseas. That would induce income into a country. So if the US government sells US bonds overseas, right, then that's going to induce a transaction of a sale of a bond, but at the same time, an exchange rate, a foreign exchange to occur, because the foreign nation would need to pay in US dollars. So this is going to be balanced by credit debit. And I'll show you, I'll give you some examples later that includes such an example. What happens if a certain financial asset is sold overseas by a domestic nation? Okay, so currency in this case is also considered a financial asset. And this is very much related to future weeks, because we're going to look at foreign exchange. And foreign exchange is a type of financial asset transaction. Okay. Capital account. Capital account is the flow of special categories of assets that are not covered under financial account. So this could include copyrights, trademarks, unilateral transfer of funds, right, under capital account would occur. Non-market, non-produced intangibles assets. So if a country forgives debts of another country, they wipe out certain debts, right? This would be under the capital account. If there is an import of, I think previously it was mentioned by, I think, Artie, that's right. What happens if technology, right, is imported into a country through like a trademark, a patent? That would be classified under capital account, okay? So most nations' value would sit under current account and financial account. Capital account would be very, very minute compared to CA, the value, the magnitude of CA and FA in this case. Because of double entry system that I'll show you later, right, of each single transaction, current account plus financial account plus capital account is equal to 0. Another way to think about this is, in terms of double entry accounting, right, is that if you look at here, CA, this is actually equals to negative financial account plus capital account. You see, double entry accounting means if you have a transaction that affects exports minus imports, if you export a good overseas, what happens? The foreign country would need to purchase it, whether they're consumers or the government or the businesses buy it. But after they buy it, what happens? Exchange occurs, foreign exchange. This foreign exchange would be balanced by a financial account transaction over here, right? So this is where the double entry accounting system, the CA transaction, would always be balanced by either an FA or CA over here. Actually, this CA is capital account. I'll use C, small a, and big A to denote this. So if a world financial body like the IMF bail out a country's debts, is it also recorded in capital account of that country? I'll show you the example later on. In our third example, we'll come to that, Arishi. Yeah, we'll definitely answer this one through an example, and it will be very much clarified later on. Okay. Yeah, so we'll come back to you on this one. Now, if we are going to look at some examples to see how the double entry system works, right? This is how it goes. Balance of payment accounts is similar to how we usually look at accounting concepts of debits and credits. So the other question is, capital account is added. How is it adding up to zero? Well, capital account is equals to the negative of financial accounts plus current account. So the negative sign, right, is what is going to induce the double entry accounting on the other side of the transaction. Okay, so everything is going to be balanced out. For example, if you have an increase in asset, right, as stated here under accounting system, right, what would happen on the other side? What would happen on the credit side usually? If you increase asset, what happens on the other side? Like cash, right? For example, if you increase cash, you could increase profit, right? Or revenue. Okay. So you could increase both of this. And so this plus would be equals to the negative of this. Okay. And things will balance out all the time. Okay. But I'll show you with some examples to show you how the CA is going to be balanced out with an FA, for example, financial account transaction, because both would have to balance. You have to. Okay. So again, I'll come back to this with more examples to illustrate this. But first of all, we should explain under the accounting, right, what happens. Accounting entity, this is always true. Asset equals equity plus liability, right? So in accounting, debit is always on the left-hand side. Sorry, I'll put it here, left-hand side. Credit is always on the right-hand side. And so therefore, asset, if asset is on the left-hand side, right, of the balance sheet here, anything that is to do with asset and there's an increase in asset, then you would increase the debit side, okay? Because asset is a left-hand side component, okay? On the right-hand side, you will always have to balance it with either equity or liability, right? So if you generate revenue, for example, okay, revenue, then revenue would be an increase on the right-hand side, more revenue, more asset, increase, because asset is on the left-hand side, okay? Also, another way to look at this is what happens if you increase borrowings? You could borrow money, okay, increase the liabilities. What happens on this side, on the left-hand side, do you think? What balances usually an increase in liabilities? Any answer to this for those who does maybe a second major in accounting? You should know this, right? From Accounting 101. What happens if I increase, say, accounts payable, which is a liability, right? What happens on the left-hand side in financial accounting? What usually would happen? Exactly. Increase in assets. Excellent. Increase in cash, which is an asset, right? So over here. Okay. So increase is balanced by increase in assets. These are general rules that you need to understand. So after today, right, if you are not familiar with these accounting terms, right, look up assets, look up liabilities, look up payments and receipts, and review the double entry accounting system of debits versus credits to see how one side, if it increase or decrease, what happens to the other side for it to balance, okay? This is a very important concept to understand in order to understand how balance of payments work in terms of foreign exchange and how exports minus imports is going to be related to a foreign exchange transaction, okay? I can give you some examples later on, but they're particular examples. They are not a general concept, right? So to understand from a general sense, review some accounting double entry system concepts, okay? So look up debits and credits, review A equals E plus L and how that helps you to understand how, for example, if you increase liability, asset increases. These are the rules that needs to be understood, okay? Similarly, if a person injects money into a company through equity, right? Through cash, A increases, E increases. Okay, so the two has a balance on both sides. Okay. Now, the next point I want to make is balance of payment accounting indicates payments and receipts of foreign currency. So what debit means is it's a potential use of foreign payments. So payments of foreign exchange. So any use of exchange, foreign exchange, any payments of Forex, foreign exchange, is going to be an increase in the debit. Okay. Any sources of foreign exchange, any receipt of foreign exchange by a country would mean an increase in the credit. Okay. Now, this is important because we need to balance either the debit or credit later on with the current account. So we are going to look at first the current account transaction and then work out whether it's going to increase debit or increase credit, depending on how it impacts the foreign exchange. And I'll go through every step with you so we understand the impact on payments or receipts of foreign exchange. Okay, so maybe wait until the example and we'll come back to this point to understand this further. Okay, so for example, go through this. Let's go through this and then we'll go back to the previous slide, right, to understand this further. But essentially what we have is an example one where you are a US consumer and we want to import a fax machine from Olivetti, from Italy. So this is going to induce the purchase of an import, right? Because we have an Italian fax machine being imported and purchased by a US consumer, okay? So that is why this is going to affect the current account in a negative way. So this is the debit, okay? Current account is going to go down. The other side of the transaction is the following, okay? Oh, sorry, this one. It's going to go down. If there is an import occurring, what happens to the flow of funds? Well, you would need to pay for this with US dollars, but Olivetti would need to go through a bank, right, to sell US dollars and buy euros, correct? Yeah, thumbs up. Can I get a thumbs up for those who is seeing how this whole impact occurs on foreign exchange from a foreign company? Are we okay with this? Yep, okay. So when Olivetti, the Italian company, takes my US check, put it into a US bank, sell USD and buy euros. This is considered as a receipt of foreign exchange. And remember, when we have a receipt of foreign exchange, is it debit or credit? It is here. It's an increase in credit on the right-hand side. Okay, it's a receipt of foreign exchange, which is this part here. It's a source of foreign exchange. So therefore, it's considered a credit because it's a receipt of foreign exchange. And so therefore, if you look at this here, when US dollars is sold, the domestic currency is sold, we are receiving euro. Okay, when euro is received, right, then what happens is financial account goes up by the same amount. You see the balance here? Remember, CA equals negative FA, right? Assuming that CA, right, is zero. So this is gone. So how does FA and CA balance out? Well, this is minus 1,000. This is minus plus 1,000, right? You see the double entry here? Both are equal. Minus 1,000 is equals to minus 1,000. So the foreign exchange occurs under the foreign account, financial account. The import occurs under the current account. Double entry ensures that we always keep a tab on any transaction under debits and credits in a balanced way. Okay, so this is considered a US asset sale. Remember, US asset sale means we are receiving foreign currency, right? So sell USD, we get euro. So the US bank faces this transaction under the financial account. So this US asset is actually the currency. We're selling US dollars, okay? Let's have a look at another example, okay? Just to clarify that we got this, right? Second example goes like this. We have you are traveling in France, right? And you pay for lunch, okay, by credit card. And so what happens is you would pay for the service or the meal overseas. So what is this then? Well, this is considered as an import, right? Because you are paying out. So the outflow is greater than the inflow because you're paying for a service overseas. Okay, so you're importing a service from France, right? And you as a foreigner pays for it. So again, negative CA. So CA minus 200 is equals to, again, over here, I'm only going to write FA just to be clear. So I'm going to ignore the capital account because this has nothing to do with capital account, right? Then once the credit card, the French restaurant, receives the credit card payment, a transaction, a foreign exchange transaction occurs. Now, how does that occur? Can someone tell me what happens? Similar to the previous slide, what's the foreign exchange? What currency is sold and what currency is purchased by the credit card company, by the US credit card company? Can someone tell me, maybe in the chat box? What happens? What currency is sold? Exactly. USD is sold for euro. So up here, similarly, USD for euro, okay? We buy euro, we sell USD. That's what the credit card company is going to do. So you're receiving euro. Because you're receiving euro, a receipt of euro, you are actually selling US asset, US financial asset, mind you. Therefore, the plus 200 is compensated by the negative 200 under CA. Over here, you got minus plus FA, which is minus plus 200. Okay, the two balances out. Okay, nice and simple. Third example. To bring the point home, right, to see how all of this occurs. But nothing is better than going through some double entry accounting in your own time to look at how asset balances with liabilities in terms of accounts receivables, accounts payables, and all that, right? Now here, you are a US citizen, you buy some shares in BP, which is a UK firm, right? British Petroleum. When you purchase the stock, this is classified under a financial account. You are purchasing a US asset, okay? So when you purchase the US asset, what happens is a negative transaction occurs, okay? You purchase the asset, right? With US dollars. But when you want to pay for it, what does BP do with your US dollars? They take it to the US bank, sell USD for British pounds. So you are receiving, right? The US bank is receiving receipt of Forex, GBP. So you're selling US dollars for British pounds. Hence, it's a credit on financial account. You see the balance here then? Okay, financial account is equals to financial account basically, because over here, negative 95 is equals to, well, negative 95, okay? They're both balanced, okay? From the debit side and the credit side. Okay, so Through these three examples, hopefully that clarifies how current account is related to financial accounts through debits and credits. Okay, let me finish the fourth example and I'll come to your student payment of fees, right? That's an interesting one, okay? Arishi, due to time, I just want to make sure I finish the examples and talk a bit more about the US case, and then I'll wrap up. So US banks forgive a $5,000 debt owed by the government of Begonia. So this is a imaginary country, okay, that doesn't exist in real life. So this is through a debt restructuring. When a debt is forgiven, we are decreasing accounts payable, which is a liability, okay, decreasing accounts payable. So over here, under the current account, we have a reduction, okay, in accounts payable. On the right-hand side, the credit, right, the credit. A US bank who holds debts thereby will reduce the debt by crediting Begonia's bank accounts by giving back the Begonian currency, by selling USD. So what the US bank would do is sell USD and buy Begonian currency and inject Begonian currency back to the Begonian government account. This is again a receipt of Forex. Hence, it's a receipt which is a positive transaction on the credit side, okay, of the double entry accounting system. Hence, plus 5,000 under the financial account, okay, because we're selling USD and buying foreign exchange to write off the debt, which is reducing accounts payable. When you reduce liabilities, right, what do? We will need to reduce the debit side. Remember, any increase in liabilities, if we go back to A equals E plus L, right? This is a right-hand side component, liabilities. Any increase in liabilities, right, on the credit side will need to be matched by a debit decrease, right? So if this is the debit side, this will definitely be a reduction of $5,000. So again, under the double entry accounting system, if we are reducing liabilities under the debit side, then this must be a negative amount, okay? On the right-hand side, it must be a positive if we're increasing liability, okay? All right, so these things will balance out ultimately again as well through the double entry accounting system. And again, the current account would need to be balanced out with the financial account through the asset sale. Okay, coming back to your question. So Roshi would, okay. I think, let's see if this answers Arushi's question. If a student makes fees payment from his home country to Sydney University, which side is it recorded? If a student would like to make fee payment from home country, they would need to sell home currency and buy Australian dollar. That is right. So from the Australian point of view, right, if we go back to the classification of what is going on here, which one would it be? Would it be debit or credit, do you think? Anyone? Which one would it be? You sell home currency, buy Australian dollar. So from the Australian government's point of view, what is happening here? Is it a use of foreign exchange or source of foreign exchange? From the Australian point of view, though, from the Australian point of view, remember you're selling home currency and you're buying Australian dollar. Rather than, exactly, it is the, no, this is the, well, from the Australian government's point of view, this is the use of foreign exchange. Okay, it's the other side. Exactly, because the Australian government is going to get USD. They're not going to sell, so they're going to get AUD. They're not going to sell AUD. Remember, like the best example to look at is, say, this one, where you have an import and Olivetti is going to go to a US bank and they sell USD for euro, right? But that's because money needs to be transacted and flow back to the overseas country, right? But in our case, we're looking from the Australian government's point of view. So what happens is there's an inflow of funds. And when there's an inflow of funds, we will need to look at it from the point of view of the use of foreign exchange, because we are going to buy Australian dollar and sell foreign currency. Exactly. For Australia, it's an export. Exactly. So if, say, the home country was China, right? You sell renminbi for Australian dollar. So from the Australian body's point of view, right, we are going to be using foreign exchange, okay, in order to buy Australian dollar, okay? So it's a debit. That's right. Okay, hopefully that clarifies this. Yeah, that's a great question. Yeah, because it adds to one of these examples, right? If you're still unsure, maybe have a look at the first two examples, which involves currency exchange, right? But the opposite way, okay, from an opposite angle. Yeah, Australia in this case is exporting. Yeah, not importing. Yeah, we're exporting our service, right? So when you export the service, you receive overseas currency, and you would need to use it to buy back Australian dollars. That's right. Yep. We can come back to this a bit later on in the consultation, maybe, because I'm wary of time. Okay. With plus fees, yes, that's right. The current account, that's right. Yeah, this would be an export. So the current account and the financial account would be negative fees. Plus fees, yes, correct. Yep, correct. Which is the opposite, right, of the first two examples, precisely. So if you think of it from the opposite dimension, opposite side of the first two examples, it would explain the answer to that question. And what you stated is correct. The current account would be a positive, yeah, number. But let's come back to that if we need to later on, because I want to clarify the three accounts, right? Oh, sorry, yeah, the three accounts in these two slides. The differences between current accounts, capital account, and financial accounts. And then we can look at the official reserve assets and end the lecture. So current account, as I mentioned, looks at exports and imports, right? So this would consist of the following: merchandises, goods like DVDs sold overseas, or services. So payment for legal services like lawyer, expats, shipping services, tourists, like the example we looked at, income receipts. So this could be in on interest and dividend payments of overseas firms, but the parent company is, say, in a domestic country. Earnings of firms and workers operating in foreign countries. So all of these, right, would be considered under the current account. Then you have the current account of gifts. So the net unilateral transfers would be subsumed under the current account, but not in the capital account, nor the financial account. Where if you have gifts, right, transfers across countries that do not relate to purchase of goods and services, right, then you would put it under a separate category under the current account. Okay, these are called net unilateral transfers, which we described before. Secondly, we have the capital account. The capital account records special transfers of assets, like trademark, intangibles, right? Patents. So we defined this before. So that's capital account. But it's a minor account for the US and for a lot of countries. So that's why most people look at current account and financial account. Now, financial account, we have the difference between sales of domestic assets to foreigners and purchases of foreign assets by domestic citizens. So this is now looking at things like sales of bonds. So if we sell bonds overseas, right, then what we've got is the inflow of of currencies into domestic country from the foreign country, or if the domestic country purchases foreign assets, like buy Japanese bonds, then what happens is you have outflow of funds, and therefore financial account will go down in that case. Okay, so it depends on whether you're selling domestic assets or you're buying foreign assets. That would determine whether financial accounts will go up or down. So financial inflow would include any foreigners lending money to domestic citizens. So this would be financial inflow, of course. So if a US citizen borrows money from a foreign bank, again, this would be considered as a financial inflow. If domestic assets are sold to foreigners, this would be a credit. Remember, credit would be a plus, what we looked at before, because the sale of domestic assets to foreigners would induce the receipt of foreign exchange. And when there's a receipt of foreign exchange, this would mean the domestic economy would acquire more money during the transaction. So you can go back to what we had previously here. This one. Okay, so credit is a positive impact on this side. It's a receipt of foreign exchange, source of foreign exchange. Therefore, it is a plus. It's a positive number under the financial account as per here. Now, financial outflow is the opposite of what I specified up here, where domestic citizens would loan to foreigners. So in that case, you have outflows of funds, or foreign assets are purchased by domestic citizens. So again, opposite to this case, right? So when we buy, say I was a US citizen and I buy, say, Australian bonds, right? Then there's going to be a financial outflow because this is going to be a debit. It's going to be a payment of foreign exchange rather than receipts. And therefore, it is going to cause financial account to go down, okay? Down. This will cause it to go up. Okay. So financial accounts can be broken up into 3 subcategories. You have international reserves, which I'll talk a bit more in detail in the next slide. So for example, Federal Reserve, the US Federal Reserve buys Japanese government bonds to strengthen the yen, right? So they are using US dollars to buy Japanese bonds, and therefore what they're trying to do is they are selling US dollars but buying yen in this process, as the bonds are denominated in yen. Okay, so they would need to sell US dollars to get yen, which is under their reserves. Using this reserve of yen, they use it to buy Japanese government bonds, and this would push up the yen as a result. Okay, so what we mean by official reserves, right, is the government's accounts that contains overseas assets, foreign assets. So foreign assets are classified under official reserve assets. Anything that is not under the official reserve assets would be classified under all other assets. For example, a US bank making a loan to foreigners. So this is not classified under any kind of foreign assets. It's a direct loan, direct transaction of funds to foreigners. Therefore, under the financial account, it's a straight through transaction of currency. Okay. There's always going to be differences between your 3 accounts, right? Your here CA plus FA plus CAA, right? Your capital account. Remember that it always equals 0. What happens if it's not equal 0? We can't say too bad, right? Because under the accounting system, everything should be matched. Well, human error can creep in, or rounding error. So therefore, if this doesn't add up to 0, right, there is a 4th aspect under the financial account to take into account the statistical discrepancy. So this is like another name for errors, okay? Classified under financial account. Miscellaneous, okay? Like that. So this would make sure that the total sum of the three accounts would add up to zero. So the data from transactions may be inaccurate, and therefore this error account would take care of the balancing. So it's like a plug. You can, see it as a plug, and this would help it to understand how financial accounts helps to balance out the current account and also the capital account to make sure all of this nets to zero. Okay. So to talk a bit more about official reserve assets, this is what we have. Official reserve assets is the type of foreign assets held by central banks in a domestic nation. The reason why the US government, for example, like to hold foreign currencies is because they can use it to buy and sell the foreign currency to reduce the financial instability of exchange rates against this foreign currency. Okay, because USD is traded against many other currencies, right? Many other foreign currencies. So therefore, the US government holds a lot of foreign assets because these foreign assets would be the foreign currencies or foreign bonds. So these assets may not just be currencies. It could be foreign government bonds like Japanese bonds, Japanese yen, gold, or they could have money deposited with the International Monetary Fund. So if the official reserve of assets owned by foreign central banks are positive or credit, then this means domestic central banks can spend more money to cushion against stability. So what I mean by this is an increase in official reserve assets is when a domestic bank, right, is owning more foreign exchange. Okay. How do they do this? Well, they can own more foreign exchange, right, by buying up, right? Because what they can do is they can sell more of, say, US bonds to foreign banks, and foreign banks, if they pay for it, if they buy, say, US bonds, then they would need to use their currency to pay for it. And this would inject foreign currency into the US government official reserves. Okay. In that case, this would increase the official reserve of assets held by the US government's central bank. Okay. Then they can use these foreign reserves to cushion against instability as specified here. If the opposite occurs, official reserve assets owned by the domestic central bank is a debit because they do not sell as many of the domestic assets to overseas foreign countries, right? For example, US bonds are held by US citizens. This becomes a debit because they are holding less foreign reserves. So to summarize, US government sells US bonds to overseas countries. This is a credit because they bring in overseas reserves into the US government's pockets. If the US government sells US bonds to domestic investors, right? It's a debit because they are not increasing foreign reserves into their own pockets, okay? So that's why it's a debit. So you can see how foreign reserves are affected by the amount of bonds or assets sold to foreign countries by a domestic country. And this is exactly what, if you actually for homework, have a look at the relationship between the Chinese government and the US government. There's a record amount of US government debt sold to the Chinese government. I want you to have a look and investigate why this is so. Because what that would mean is a lot of renminbi, right, would be held by the central bank in the US government, okay? So there is always a balance that takes place of foreign exchange versus financial assets that are sold by the domestic nation to the foreign nation. Okay, I'll come back for more questions because that's a very interesting one later, or you can have a look at that case for homework first and then come back with more questions. Right, so what does the negative value of official reserve assets mean? Well, this means we have a negative balance of payment. Remember, our balance of payments, sorry, let's go back a step. A negative official reserve of assets would mean we have a what, positive or negative financial account? What does this mean, first of all? Can someone tell me? Positive or negative? So we have a negative value of official reserve of assets. Okay, and if we go back to the definition, financial account has three categories, right? If this first category is negative, what does it mean by the financial account? Negative official reserve of assets means negative financial account. Okay. When we have a negative financial account, ignoring capital account, right? What does that mean to the current account? Can someone tell me? Exactly. Remember? Yeah. So if we have a negative FA, right? Ignoring CA, the capital account, okay? This is a positive FA, okay? So it's going to induce a positive effect on CA, okay? So it must always balance, remember? Now, balance of payments is considered as, let's go back. What is the balance of payments? Didn't we define it before? Balance of payments are separated into current account, financial account, and capital account, right? It is a country's balance of payments accounts for its payments to and receipt from foreigners, okay? We can either look at it from the current account perspective, or we can look at it from a foreign account perspective, ignoring capital account, right? Ignoring that for now. So then fast forward back to this, to understand this now, this relationship. A negative value of official reserve assets is a positive current account. It also means the balance of payments is going to be positive under the current account. In other words, the balance of payments is going to consist of the sum of the current account, the capital account, and the non-reserve portion of the financial account, and any statistical discrepancy, because all of this must be equal to zero. So all I'm saying is the following. Let's write it out. Again, down here, remember CA plus FA plus CAA equals zero, right? If I have current account, okay, all of this is the balance of payment. The balance of payment must be, well, equal to zero, but I am going to break up FA into two parts. Reserve, okay, let's call it reserve, plus FA, non-reserve, right? Plus CAA equals zero. Now, if you think of this sentence then, balance of payments is a sum of the current account, the capital account, and the non-reserve portion of the financial account and any statistical discrepancy, which we assume to be zero, right? Then all that means is CA plus non-reserve plus capital account. That is, it must equal. Move it to the right-hand side, negative FA reserve. Okay? Which means exactly this. Negative financial account under the reserve component, or the negative value of official reserve assets, is equals to what is described on the left-hand side mathematically, okay, which I've to understand. This is equals to the left-hand side of here. Okay, but except I moved this part to the right-hand side, okay, to make it negative. So that is the balance of payments. You can either see it as a negative official reserve of assets, or the balance of payments is current account plus any non-reserves of financial account plus capital account. Okay. Now, what does this negative financial account for reserves indicate? If a country consistently have a negative official settlement balance, right? A consistent negative official reserve assets, like the US, it either means they are depleting, they're using a lot of their official international reserve assets. They're utilizing it, right? More than they are getting it. Danger, okay? Because they are not able to cushion against financial instability. Secondly, they may be incurring large amounts of debt over time against foreign banks. So the US government is exactly under this situation. They are net borrowers rather than lender in the global open economy. So the domestic, the US central bank, for example, is spending a lot more to borrow money, to buffer, to keep a lot of foreign exchange by borrowing money to protect against financial instability. So who are they borrowing from? Well, can someone answer that one, Artie? Who are they actually borrowing from? Who do they sell a lot of their treasury assets to? Which is their biggest financial account trading partner? Public? Who's the public? Local public plus foreign public, right? Who's the foreign public? Who would be purchasing a lot of these treasury notes and bonds? Which country do you think would be the biggest trading partner in terms of financial accounts with the US? Exactly, China. That's right. Used to be Japan, but the trading relationship has diminished somewhat over time. The US government used to keep a lot of Japanese yen. Yeah, but they still do, but now it's shifting towards the renminbi. That's right. So again, another point for homework maybe, because there's so much underlying this interesting discussion, right? I could go on and on, right? But we don't have enough time, but because I need to move on to the consultation. So I'm now going to finish up by looking at the US case study, right? To illustrate what is going on with the US current account and how you can see, first of all, in 2016, right? These 2016 figures, you can see that US is a debtor nation because look at the financial account, first of all. Its official reserve assets is negative here, here, and the net financial flows is negative. It means it's borrowing a lot of money, okay? This indicates a lot of debt, okay? It's sustainable and it's not worried, okay? It might come to a point in time where it becomes very worried, but no one wants the US economy to collapse because the US is a major trading partner, right, with a lot of nations. So everyone would, well, most people would want to prop up the US economy. So they'll keep feeding this system, right, as long as it works well and grow the US economy. So as long as the US government thinks it can repay its debt, it will think it's fine. Okay. Now, the next point I want to make is if the US has the most negative, right, official reserve, which means it has a negative net foreign wealth in the world, as I've shown you in the slide where you see the red line, right, dropping over time. It is the world's largest debt nation because it sells a lot of its treasury assets to China and to Japan. So its current account deficit in 2012 was $440 billion. So the net foreign wealth continues to decrease over time. The value of foreign assets held by the US has grown. But then you might ask, how come if it holds a lot of foreign assets, why would it be a negative net worth foreign wealth nation, right? It's because its debt has also increased over time. It has sold a lot of its assets to foreigners as well at the same time. And this selling has gone on faster than how much the US has been purchasing foreign debt asset. So if you net the two out, right? The debt part is overweighing the other part, okay? So more and more debts has been accumulated over time. So a lot of debts, 70% of foreign assets held by US are denominated in foreign currencies, and almost all of the US debts is denominated in dollars. So final point is the changes in exchange rate will influence, of course, the amounts of net foreign wealth between the gross foreign assets and the gross foreign liabilities. Remember, how much asset does the US central bank hold versus how much debt it owes to foreign nations? This is very much influenced by exchange rate. As the USD changes over time, right, the net foreign wealth would also change, okay? So for homework, I want you to think about what happens in terms of appreciation of foreign currencies against the US dollar. So if the US dollar weakens, have a think about this concept here. What would happen to the US debt? Would it increase or decrease? Okay, so have a think about this point. And then finally, I want to touch on the summary of what I showed you before in the previous slide, that the point about the foreign assets held by the US central bank, which is here, the blue line. It used to be positive in the 80s. Since the late 80s, it's declined. It became a detonation because the red line is now very much greater than the blue line. And the red line is the gross foreign liabilities. So the US government has been borrowing more money than how much foreign assets it holds against foreign nations. Okay, so this contributed to the US becoming one of the largest detonation. The net foreign debt is becoming very substantial over time. Okay, that is all I want to talk about. I'm going to stop recording and see if I want to take any question. Okay, sorry for going over time. Feel free to watch the recording. And next week, I will post the assignment instructions. Hope you enjoyed the lecture. Thank you, everyone.